In 1888, the Pennsylvania Railroad Company decided to build a railway. Now, they needed $1.5 million to do this. They could have issued shares. They decided not to. They wanted to go down the debt route. They could have gone cap in hand to the bank and borrowed it all from one lender. They decided not to do that either. What they actually decided to do was to raise the $1.5 million from many, many lenders. And to do that, they issued bonds. And this is what bonds look like. A bond is just a certificate. It's an IOU. It's a piece of paper that says, in this case, the Pennsylvania Railroad Company owes you some money. So how do they work? Well, like shares, they have a nominal value. And that's what's going on here. In this case, the nominal value is $1,000. And that's what they're going to appear at on the balance sheet, sometimes also known as the book or the face value. It's not the same as the market value. The market value is going to be something different. The market value is going to depend on supply and demand and interest rates. So by issuing one of these bonds, the Pennsylvania Railroad Company has borrowed $1,000 from the investor. Now, in terms of what the investor gets in return, you might need to squint for this, but here we're told something called the coupon rate. And the coupon rate in this case was 4.25%. And that 4.25% represents the interest that is paid on the $1,000 nominal value. In other words, if you hold one of these bonds, the Pennsylvania Railroad Company is going to pay you $42.50 worth of interest every year. As an interesting aside, the reason it's called a coupon rate is that if you look at these things here, these are the coupons. And back in the day when bonds were a physical piece of paper, each year the investor would tear one of the coupons off, post it to the company and get their interest back. The final thing with the bonds is that invariably investors want to have their money back, and tucked away in the terms and conditions is the redemption date. And in this case it was 1938. So remember, the Pennsylvania Railroad Company issued the bond in 1888. 1938 is 50 years later. So by buying one of these bonds, the company is going to pay you $42.50 each year for the next 50 years. And then in 1938, you get your money back, which invariably is the nominal value which gets repaid.